We got two timely and extremely useful reminders Friday when we woke up to the news that Wall Street had dropped 300 points, the biggest drop in the market for some months. And it was a very timely reminder to tell us that global equity markets are pretty fragile. In the US and in the Northern Hemisphere generally, they've been underwritten by those extremely low interest rates and all that money printing. Well, the money printing is coming to an end by the end of November, certainly in the US, and then you might start to see interest rates go up. And that spells certain uncertainty for the US market, and that's the second reminder we got, that we still live in a world made overnight in America. We wake up to what's happened in global markets, particularly what's happened in the US, and that pretty well underwrites what happens in our local market. We might deviate from that from time to time, but in general terms, we are hostage to what happens, particularly on Wall Street. Obviously, as we saw most dramatically in 2008 with the global financial implosion. The good news out of the plunge in equity markets overnight was the A dollar went below 93 cents. Well, it's good news for some, but also perhaps slightly unsettling news, because in a very broad sense, a weaker dollar removes that big constraint on the Reserve Bank if it wants to put up interest rates. The big worry in the Reserve Bank was if we actually raised interest rates when the rest of the world was still very low, we could send the dollar back towards parity against the US dollar. So once you remove that constraint, if the A dollar stays below 93 cents or indeed drops below 90 cents, that increases the chance of an interest rate rise from the Reserve Bank, obviously if it wants to raise interest rates, because the other side of that coin is a falling dollar in the wake of global turmoil is probably not a good sign of what the economy is going to be doing over the next 12 months. So countering that, the Reserve Bank may not be in all that of a hurry to raise interest rates, even if it gets a lower dollar. Well, we're going to find out to some extent next week. Tuesday, the next meeting of the Reserve Bank Board, it will leave interest rates unchanged. It will also leave its guidance unchanged, i.e. that it still thinks interest rates should stay stable for a period. The very interesting, perhaps the more interesting indicator of where the Reserve Bank might go comes out 3 days later on Friday, when it updates its monetary policy statement. That gives you a much broader view of how the Reserve Bank sees the world, and in particular the two things that are fundamentally important to determining what it does with interest rates. Inflation, the outlook for inflation, and the outlook for growth in the economy. You might see the inflation outlook be kicked up a little bit after those surprising to some June quarter inflation data. You might also see it being adjusted downward now that we really do have the abolition of the carbon tax bringing down not only headline inflation but also underlying inflation in the 2015 year from where it would otherwise have been. So Tuesday and Friday, in the context of what's happening in global financial markets, is going to provide an interesting and very useful guide to what happens to interest rates. Finally, we saw the institutions flex their muscles in Woodside and prevent the selective buyback of the Shell stake. This was not an exercise of institutions acting for the good of all shareholders. They were acting very much in their own enlightened self-interest, because if the Shell buyback doesn't proceed, the institutions were hoping for two things. One, that the board of Woodside would substitute a general buyback which would enable them to sell shares at an attractive price into the buyback rather than it all being reserved for Shell, and in particular those franking credits being reserved only for Shell. But secondly, if Shell can't sell into the buyback, it still wants to get out of Woodside, so it would then make another placement of its stock to the institutions, presumably at a discount to market. So bottom line is the institutions would pick up two benefits: selling into the company's buyback, and also then buying back into the stock via Shell. Michael Chaney scotched that to some extent, the chairman of Woodside, when he said the board had no intention of rushing to a general buyback if the Shell one was rejected, because the Shell exercise was not about reducing capital, it was about